The Hong Kong stock market experienced a dramatic surge in March 2025. The Hang Seng Index, or HSI, jumped nearly 15%, reaching its highest point since February 2022. This impressive growth wasn't fueled by the usual suspects. Instead, mainland Chinese investors took center stage. They poured money into the Hong Kong market through the Southbound Stock Connect program. This marked a significant shift in market dynamics. Previously, foreign investors were the primary drivers of the Hong Kong stock market. The influx of mainland Chinese money signaled a growing confidence in Hong Kong's economic prospects. Investors were particularly drawn to the technology sector. Chinese tech giants like Xiaomi, Tencent, and Alibaba saw significant gains. These companies benefited from the increasing integration of the Hong Kong and mainland Chinese economies. The March surge was a clear indication that the Hong Kong market was back on the rise. The dominance of mainland Chinese investors continued into April. Data revealed the extent of their influence. In the last week of February 2025, mainland investors bought a net 75 billion Hong Kong dollars, or 9.6 billion US dollars, worth of Hong Kong shares. This marked the highest weekly volume since January 2021. Southbound Stock Connect activity, the channel for mainland investment, now represents a quarter of total market turnover. This is a dramatic increase from just a few months ago. This shift in market dynamics has significant implications for Hong Kong. Increased mainland investment brings both opportunities and challenges. The influx of capital can fuel economic growth and support the development of key sectors. However, it also increases Hong Kong's dependence on the mainland. This can make the market more susceptible to policy changes and economic fluctuations in China. The Hong Kong market showed its resilience in April. Despite facing a significant drop in early April due to US tariff hikes, the HSI rebounded strongly. The market closed at 21,562 points on April 22, 2025, representing a 0.78% increase. This recovery demonstrated the market's ability to withstand external pressures. Other key indices also reflected this positive trend. The Hang Seng China Enterprises Index, which tracks mainland companies listed in Hong Kong, rose by 0.68%. The tech-heavy Hang Seng Tech Index also saw a 0.24% increase. This rebound was driven by a combination of factors. The market seemed to move past the initial panic caused by the tariff hikes. Investors focused on the long-term potential of the Hong Kong market, particularly in the tech sector. The recent performance of the Hong Kong stock market paints a picture of volatility and opportunity. While the market has shown strong growth potential, it remains sensitive to external factors. These include US market trends, Federal Reserve interest rate policies, and ongoing US-China trade tensions. Navigating this complex landscape requires careful analysis and a long-term perspective. Despite the inherent risks, the Hong Kong market remains attractive to many investors. Its close connection to mainland China, particularly in the rapidly growing tech sector, provides unique opportunities. The recent expansion of law firms like K&L Gates, bolstering their capital markets teams in Hong Kong, further underscores this attractiveness. The firm's move to strengthen its presence in the region reflects the growing demand for legal and financial expertise as more companies seek to capitalize on the opportunities presented by the Hong Kong market.